If you're an investor in the stock market, this chart is one that you must understand. It's going to have a big effect on your profitability in the market. I'm going to show you what this chart is, how to use it, and then I'm going to provide my analysis of the stock, commodity, currency markets. And then finally, in this week's video, I'll take a look at a trade that went up over 250% in just 2 days in a very simple way that I found it. That's all coming up in this week's Stockscores Market Minutes. All right, so here's the chart that I had at the top of the video. It's a chart of the US Treasury bond market. And you can see that from 2008 until 2020, it was generally in an upward trend. Now, what that means is that the interest rates that you pay on your mortgage, interest rates available to companies to borrow money, was declining steadily because there's an inverse relationship between the price of bonds and interest rates. So if this chart's going up, then interest rates are going down. And that was the case for well over a decade. But in 2021, late 2019, late 2020 and into 2021, 2022, we saw that trend reverse. You can see that on the right side here, we've had this general downward move in the bond market, which means interest rates have been climbing steadily. And that's one of the reasons why the stock market did so poorly in 2022 and really hasn't been great in 2023 either. Now, it's important to understand that the bond market is an estimation, or the bond market's, essentially an indicator of what central banks are likely to do. The stock market tends to focus on one or two things at any one time. And right now, the future direction of interest rates is the number one concern for the stock market. So this chart of TLT is telling us what the bond market thinks the central bank in the US, the US Federal Reserve, will do in the future. And it's very good at predicting interest rate policy. And so when you see that chart going down steadily, what it really means is that the bond market was predicting that interest rates would rise. And in fact, the bond market started going down before interest rates really started to rise. And then more recently, because the bond market realized that the US Federal Reserve wasn't probably going to drop rates anytime soon, it fell again. It wasn't that the bond market thought that interest rates were going to go higher from the Fed. It's that the time it was going to take until interest rates were lowered was going to be longer. And that's why we saw the most recent drop in the bond market, which meant the real interest rates that you pay when you get a mortgage went up. Now, it's important for stock because the stock market tends to be inversely related to interest rates, particularly small cap stocks. So when interest rates rise, the small cap stocks suffer. And I'll show you a chart in a minute where you'll see the effect of interest rates on small cap versus large cap stocks. The big companies like Amazon and Apple, they don't tend to borrow as much money as a smaller company would, and therefore they're not as sensitive to interest rates. Now, they're still somewhat sensitive because the economy will be better when interest rates are low, and people are going to buy more iPhones or more stuff on Amazon if the economy is strong. But in the last little while, we've seen interest rates rising until this most recent month. And here is now a weekly chart of the bond market. And you can see that over the last month, the bond market has been rising, which means interest rates have actually been falling. Now you can see that happened here and it happened here. And so it's not a really big deal yet, because ultimately what we want is for the market to break up from a rising bottom. So you can see how these bottoms are falling. Well, if the market had broken up here from rising bottoms, then that would have predicted a rise in the bond market, which means a fall in interest rates. So we've taken the first step. We're basically where we were back here. And now if we can build a rising bottom and then break up from a rising bottom, that'll mean that the bond market is predicting that interest rates are going to go down, and that's going to filter through to the stock market and make the stock market a better place to be. Now, the reason I bring this up this week is because unlike back here when you had this little rise, let's draw that again. Back here you had this little rise, back here you had this little rise, and then you had a fall and a fall. But the difference now is look at the volume. When markets bottom, typically they do so with very high volume. And you can see here when there was this little rise here and this fall into it, volume wasn't really that strong. Same thing here. The volume as the market fell wasn't really that strong. But here, look at how much higher the volume is. And it's almost like there's this panic selling where everyone runs for the exit door at once. And that is a good sign of a bottom. So I think we have a good chance that we have seen the bottom in the bond market, which also means the top in interest rates. And that should be supportive for stocks. Here is the daily chart. And on the daily chart of the Treasury bond market, you can see that we're starting to get some little rising bottoms building, having broken this downward trend. So again, the signs are there that the bond market is bottoming, and that should help stocks. So with that in mind, let's now jump into some charts of the stock market. Now here is the daily chart of the S&P 500. And you can see that in the time that the bond market has started to move up, which means interest rates have moved down, the large cap stocks have moved up quite nicely, but they also didn't fall as much when the bond market was falling because they're not as sensitive to interest rates. So I'm going to show you a chart in a minute where you see the effect much stronger in the small cap stocks. So we've got a nice little 1 month rally in the stock market. You can see here over the last month, it's been pretty good. So that's a bullish indication for stocks in the short term. And in the long term, we've rallied nicely, but we're coming into this ceiling price that was hit back in August. And so it's likely that the stock market, the large cap stock market, is likely to stall in the next week or two, most likely. Now let's take a look at the NASDAQ. QQQ is the symbol. And here, if we go to the 1 month chart, you can see much like the S&P, it's been rallying quite nicely. Looking at the 3-year chart, it's even a little better than the S&P because here you can see that it's actually broken through that little ceiling price from the July-August highs. And that means it's probably headed to this ceiling, which gives us a little more upside until it gets stuck. So the large cap tech stocks look a little better than stocks in general. Now, what about those small caps? IWM is the symbol for the Russell 2000 ETF. And let's take a look at the 1 month chart here. And you can see that it's been rising, but it's been much more choppy. This market is more sensitive to interest rates. And although interest rates have fallen a little bit, it hasn't been good enough yet for these stocks. However, the pattern that's building here is a really good one for the future direction of this market. This is called an ascending triangle. So we've had a general rise. We're building rising bottoms, so that's positive. We're compressing in volatility. By that I mean the swings in price for the Russell is getting tighter and tighter. And so all we need now is to break out through that 180 level on the IWM, and that should mean that the market moves up from there. So watch for that. It should happen probably next week. There is a chance, of course, that it could instead break down, breaking this cycle of falling tops. I would say there's a 30% chance of that happening. And if so, then you want to be a little bit more defensive in the short term because we're probably going to pull back to that upward trend line. All right, well, what about the Canadian market, which is much more commodity based? T.XIU is the symbol there. And you can see it's been a lot choppier, a lot really lacking trend. And that tells us that investors are generally uncertain about Canadian stocks. They're neither bullish, optimistic, or bearish, pessimistic. They're just kind of stuck in this range. And it shows up even more when we look at that 3-year weekly chart, where we see it's just been going sideways for well over a year. And that tells us again that the market participants aren't really optimistic. They're not really pessimistic. They're just kind of stuck in a sideways range. And it becomes important then to really select stocks that are trading on their own story, because most stocks will just go sideways like the overall market. They're not being lifted by a strong market. They're not being dragged down by a weak market. Well, let's look at some of those commodities now. Here is gold. And you can see that gold had a pretty good week last week. It shows up more when we look at the short-term chart. You see there a nice little rally. The problem is it has come up to this ceiling price where we expect it to get stuck. So in the short term, I think gold's probably going to stall there. If it breaks out through that, okay, then we can get a little more optimistic. But looking at the 3-year weekly chart, you see a problem, and that is this resistance that is held up is essentially where we're at right now. And so I think the upside for gold is somewhat limited unless something really negative happens politically in the Middle East, for example. Then you could get a breakout through that level, and then we're going to be bullish on gold. But for now, I would say it's fairly neutral. All right, what about oil? USO is the symbol, and oil was, in the news this past week as OPEC delayed a meeting. You can see the general downward trend in the oil market. Until this downward trend is broken from a rising bottom, I want you to be fairly careful with oil and oil stocks. However, we could very easily next week get a break of that downward trend line. We've got the rising bottom in place. So this is a market that could go from negative to positive with one good day. All we have to do is break that short-term downward trend line. Now, if we look at the 3-year weekly chart, the big picture is that we're still stuck in the sideways range. Prices are good. Energy companies are making good money right now because the price of oil is still high historically because, of course, we had this really strong rally in 2020 into the middle of 2022. Well, let's now take a look at the bond market again, but this time we're going to look at an inverse ETF on the bond market because this is easier to read in terms of interest rates. Because this is an inverse of the bond market, what it basically means is that if this is going up, interest rates are going up. And so you can see the rise in interest rates there. And over the last month, you can see the fall in interest rates. And so this is now looking better for the economy. But when I talk about this chart as being bullish or bearish, it's really a bearish chart. What that means is that the outlook for interest rates is more likely down, which is bearish, down is bearish, than up. Okay, so again, a bearish market for interest rates is good for everything else, and we shouldn't forget that. All right, final couple of charts I want to look at are some currencies. Let's take a look at the US dollar, because if money is coming out of the bond market and if the bond market is going down, that means interest rates are going up. If the bond market is going up, interest rates are going down. And you can see that if the bond market goes up, interest rates are going down. That makes it less desirable to hold US dollars, and that's why the US dollar has dropped. If we put this in the context of the long-term chart, here's the 3-year weekly chart, you can see that we had a nice run higher in the US dollar as the bond market was going down and interest rates were going up. Now it's starting to roll over, meaning interest rates are starting to fall again. That's negative for the US dollar. It's positive for the stock market. Final chart we want to look at is GBTC, which is for Bitcoin. And I put a bullish rating on Bitcoin way back here when it broke from a rising bottom. So we talk about this all the time. There's your downward trend, build of a rising bottom, and then breakout from a rising bottom. So that's when my rating became bullish. And since that time, that was at about $15. We're now just a little over $30. So it's gone up 100% in less than a year, all from that break up from a rising bottom. Well, that's the kind of thing that we now want to watch for in the stock market, where we break a downward trend line, we build a rising bottom, and then start to move up. And there's so many stocks that have this chart, and they're kind of right here right now. They're breaking their downward trend lines, but they haven't made that break up from a rising bottom yet. But that's going to happen, particularly in small cap stocks, which I think is the area to watch for opportunity, because again, so many of them have been in steep downward trends for over a year, and they're starting to stabilize, starting to build that rising bottom, and that's where the opportunity is going to come. All right, so what are my ratings then? Bullish and neutral for all the stock markets. Short-term bullish, long-term neutral. For gold, neutral on both time frames. Oil, bearish in the short term and neutral long term. The same for the US dollar. And on Bitcoin, bullish on both time frames because we do have an upward trend there. And then interest rates bearish in the short term, which again is good for the economy, and neutral long term. All right, at the top of the video, I said I was going to show you a trade that went up over 250% in just a couple of days, and more importantly, how I found it. So this is a strategy I use and teach in my active trader course at Stockscores.com called the Alpha Echo. And the way this strategy works is we look for stocks that have alpha, that have abnormality, and we wait for them to quiet down. And then we look for the action candle, which is my own indicator, and again, something you can get if you're one of my students. And with the action candle indicator, it's really a measure of strong buying coming in. It's abnormal price movement with abnormal volume, using statistics, using the data from the stock market to tell us that the buyers are getting excited again. And I love it when the buyers were excited and then they kind of lose interest and then they get excited again. And that's where that action candle comes in. And you can see that that was at $1.10 on the 21st of November. And then on Wednesday, the day before the holidays, we had the big run up, probably over 20 times risk. In other words, if you risked $100, you made $2,000. You risk $1,000, it's a $20,000 profit. The sell signal was right about there when we broke down from a pennant pattern. And so even at that point, it's probably 16 times risk. Really nice trade. And then, of course, with the market closed on Thursday and then very quiet on Friday because it was a half a trading day on Friday, it just kind of got quiet again. But this stock could still do more. You know, it's a stock to continue to watch for the next sign of life. It gets quiet, and then if it comes alive again, something to consider. This is a strategy I call the Alpha Echo. And again, you can learn more about that at my website, Stockscores.com. Well, I hope that you've enjoyed this week's Market Minutes. And if so, click on the like button. Let me know, what are your thoughts? Is the bond market truly bottomed out? Are interest rates topping out here? Or are we going to get another wave of higher interest rates? Let me know in the comments. And most importantly, trade well.